So now we're going to list and apply some basic accounting assumptions and principles. Different assumptions. So one is the business entity assumption. And what that has to do is that the accounting for a business is going to be kept separate from the personal affairs of its owners and that of other businesses. So this is really important. And I've mentioned this, I know, before in a previous video, either with this chapter or back in a previous chapter, but it's important. And a lot of, especially people that own their own business and the sole proprietors, it's very easy to commingle funds or to maybe think something is a business expense when it really was a personal expense. And it's really important that you keep those things separate. One, because you need to know what the business is doing, you know what you're personally doing, but also because, of course, when you go to file your taxes and all of that, it's what the IRS demands. So it is really important to be aware of that, keeping business expenses, business revenue separate from personal expenses and personal revenue, just being aware of that. And again, the best thing you can do if you're going to start even if just a very small business, maybe selling, as I said, selling, things that you make on Etsy or mowing lawns or maybe doing auto mechanic work on the side or, different things, setting up a different bank account and having that, just something even just as basic as that can be really helpful to you, but it's important. So the going concern assumption means that the business is going to continue to operate for the foreseeable future. Obviously, we're not going to go into business and then think, well, we're going to just stop doing it. So we want to assume that it's something that we're going to do into the foreseeable future. Now, if a business will not be able to continue operating into the foreseeable future, then the balance sheet must show the value for which the assets could realistically be sold. So the monetary unit assumption is that the business's financial position would be expressed in terms of money, and also that all the accounting records would need to be reported within using a single currency. So either, if you're here in the United States, in US dollars, if you're, in Canada, Canadian dollars or euros or what have you, and also making sure, you standardize on that. And if you're a business that's doing business in multiple countries, maybe you're an international business, making sure you standardize on one, currency and use and stick to that. And then also the time period assumption is that accounting is going to take place over specific fiscal periods of equal length. So you're going to do, either do a report every month, every quarter, every year, obviously, because you'll need that for taxes and to know, every year. But you're doing that over in particular time periods. So some different principles. We have the measurement principle, which is the process of determining the amount at which an item is going to be recorded on the financial statement. And so primarily, items must be recorded at their historical cost. And that's one thing about accounting you're going to realize is a lot of it's going to be, at least for this, primarily, especially for financial accounting, it's going to be looking at what we did in the past and reporting on what happened in the past. Okay, that's important. Now, revenue recognition is that revenue can only be recorded or recognized when the goods are sold or when the services are provided. And that may or may not be necessarily the same time that the goods are, or that payment is being received. The item that is sold would be transferred to the buyer, and the buyer would have agreed to pay or has already paid. But again, that may or may not be necessarily at the same time. But we're going to recognize revenue when the goods or services are being sold or being performed. Now, the expense recognition is an expense also then is going to be recorded within the same accounting period in which it was used to produce revenue. And so if you sell something this month, you're going to report it in this month's figures. Okay. And that's really important, and the cost with that. And the same thing, with the expenses. You use something this month, you're going to report it in this month. And that's important to keep everything aligned that way. together. Now, disclosure has to do with the fact that all information that affects the full understanding of a company's financial statements has to be included in the statements. And it might not be necessarily within the actual figures, but there's going to be a note on there specifying that. And so, for example, there's times where I'd say that there might be a pending lawsuit or a tax dispute. It doesn't affect the accounting records directly at this time because it hasn't been settled yet. But there would be a note that would accompany the financial statements to state that because it has the potential to affect. So we would put a note specifying that. Okay, so which of the following is not an assumption under the conceptual framework of accounting? Is it A, the business entity, B, going concern, C, materiality, or D, the monetary unit? And it's materiality. We haven't discussed that yet.